Hey there, this is Stephen Gardner. I'm the best-selling author of Taming Wall Street and a few other books, and had a question come in about doing an Airbnb out of your infinite banking policy or out of your cash value life insurance policy. And I did a video not long ago about Airbnb out of your bank on yourself plan, but in my mind, they're very similar. The philosophies are very similar. I really think it comes down to what company are you putting it with, who's your money mentor, did they build it correctly? As long as it's built correctly and with a company that has a good borrowing rate and a good track record for growth, you're going to end up being just fine. But I did want to kind of talk about some of the mechanics of doing an Airbnb out of your cash value insurance policy. My wife and I have done some hard money loans. We've done some house repairs ourselves. We've also done some rental properties as the market was getting hot, and felt fortunate to have the resources or the financial capital to participate in those awesome opportunities. But right now, this hot thing is Airbnb, and I've definitely been studying it and looking into it and meeting with mentors, and I think it's something that my wife and I will pull the trigger on at some point. But I did want to just talk to you about how that would work. So basically, I want to talk about the mechanics of how you would use that money, and then maybe the two different ways that you could figure out your return on investment, right? So you're going to go to your insurance company, and if it's structured properly, your advisor, or if you're with me, we will go through and show you how to take out that loan. Depending on if you have a variable or a fixed loan or a wash loan, either way, you're able to borrow that capital. And I don't, obviously know how much you would have in your plan, but let's just say that you have $100,000 in cash value, right? You've been building it up. And so you would borrow out of that plan, and let's say that you needed to put down 30 or 35,000. Let's just say 35,000, right? For a down payment and closing costs. So you borrow that money, and then you use it for getting into that home. You probably need maybe another, let's just call it 10,000 in order to furnish the place. Now, this is the difference between the rental properties that clients of mine have done and myself. You have to furnish, and that's got to be part of the capital that you put up. But that's okay, because this is a long-term opportunity, right? This is not a get-rich overnight kind of a situation. So now you're into this 45,000. That's what your capital is, right? Then you're going to have a mortgage with insurance and escrow for the different things. So basically just your normal mortgage. You're going to go out, you're going to furnish it. Because this is for a business, you're going to get to write that stuff off. So you're going to get a write-off on that money, but you're also going to be able to put it to work for yourself, okay? And then most likely you're going to want to hire a property manager. For me, I just don't have time. I don't want to deal with the ins and outs of people coming in and out of the property. So I would probably have somebody take that over for me. So then what you're going to do is you're going to be cash flowing, and then you've got to cover those bills. You've got to cover the mortgage and insurance and water, light, all those things. So, but then whatever is left over, then that's your profit. And you're probably going to want to stick some aside for maintenance or repairs, whatever it might be. And then you are going to, at the end of a year, or maybe an 18-month period, 2 years, give yourself a little bit of time to see what your actual track record is. Then, as part of your mortgage payment, if you have the money, which you should, otherwise, if it's not cash flowing right away, then you've made a mistake, right? So part of that money is going to go to the mortgage company, but part of that needs to go back to the insurance company, okay? Because when you borrow, you are still paying interest, right? And that's the power of this. This is how you're able to earn interest on your money as if your money were never gone, because truth be told, your money never is gone. You're actually using the insurance company's money, right? And so you've got to make those interest payments, but then down the road when you sell, whether you break even or have some equity build up, whatever's left over you can dump back into your plan, right? But in the meantime, now you've purchased a cash flowing asset and you're making those payments, and then whatever is left over, that's what you're going to figure out. Okay, here's my ROI, right? So there's two ways that you can look at it. You can say, okay, I'm going to base it on the amount that I borrowed. And so let's say after a year, you've made $4,500 on this new cash flowing hotel business, right? You would divide that in and you'd go, my goodness, I made a 10% return on my money, right? But it's actually a little bit better than that, because where your money is still in earning 5, 6, 7, 8%, whatever it is, then you have to take into account that your real cost is what the insurance company charges you in interest, right? And if you have a 5% loan, then you're going to be a couple $1,000s in interest, right? So then you take that 4,500 divided into, let's just call it like 2250, right? You divide that in, and now that's your ROI, right? So on that small amount of money, you actually have a really good leveraged rate of return, because internally you're still earning. I hope that makes sense. If not, we can discuss it. So again, you can look at it two ways. And maybe if you're already doing this, leave a comment below. How would you calculate the interest? When I look at it, I look at my money is growing tax-free at whatever it gets with the insurance company. And then whatever I can do in the real world, I go off of the actual cost of borrowing that money from the insurance company. That's how I personally like to look at it. But I know other people that they say, hey, this is what I borrowed, and until that's paid back, I'm basing on that. But it still ends up being a cash flowing property that can go up in value and up in rents down the road, and be a good profitable business for you. So if you have any questions, please leave them in the comments below. If you're already doing an Airbnb, leave a comment in the comments below. But if not, and you want to learn more about Bank on Yourself or infinite banking concept, or you have questions after reading my book, Taming Wall Street, that has over a dozen real life examples, please reach out to me at Stephen with a PH at yourbridgeplan.com. Otherwise, I wish you the best of luck in getting one of these cash value plans up and running. Just make sure you do it with someone that knows what they're doing and is going to be around for the long haul, that practices what they preach. And then when it comes to Airbnb, just make sure that you can figure out the numbers on the front end so that you buy an asset that's cash flowing from day one, or has that potential, and you're not just waiting on that upside opportunity. But anyway, again, this is Stephen Gardner, author of Taming Wall Street, just giving a little bit of insight into using your cash value plan to do real estate, and specifically on this video, your infinite banking policy on doing Airbnb. Hey, thanks for checking out this video. Give me some likes if you like what you heard today. Go ahead and subscribe to my channel and click the bell so that you're notified of future videos. Thanks for checking out today's video.